हाय गाइस, दिस इज़ यदीप एंड वेलकम टू द लेज़ी इन्वेस्टर चैनल। आज हम बात करेंगे एक ऑप्शंस ट्रेडिंग स्ट्रेटजी की, जो बहुत कॉमन नहीं है। इट्स नॉट वेरी पॉपुलर इन द ट्रेडिंग कम्युनिटी, बट इफ़ यू नो हाउ टू एग्जीक्यूट दिस स्ट्रेटजी प्रॉपरली एंड इफ़ यू कैन कीप द वेरिएबल्स इन चेक, it's a very good strategy for passive income. So one of the major drawbacks of this strategy is that it requires a lot of patience, and I think we can agree on the fact that patience and options trading don't go hand in hand. A lot of option traders I have seen getting impatient because this strategy requires a lot of patience and you have to keep running the same position over and over every month. So let us start with some of the basic groundwork which is needed for this strategy, and then maybe I'll walk you through the actual execution of this strategy, how we can kind of make a consistent return year on year using this strategy. Because it's not exactly a very high ROI strategy. It will minimize your returns, but also on the other side it will probably minimize your risk a lot. So let us start with this. So as you can see, I have logged into Zerodha. Now before going into the details, let me talk to you about the strategy a little bit. So the strategy is called as option wheel. Now exactly what does that mean? This means that we are going to construct an option wheel and then we are going to rotate it again and again. I'll come to the explanation in a while. So this is a very common strategy. If you go to Amazon and type option wheel, you will find a couple of books which are written on the same strategy. So you can look at these books which have already been written, and this is a strategy which is followed in many of the markets, not just India. So now coming to the steps of the strategy. So step number one is that we select an underlying. So this is a very critical step. If you are able to select the right underlying, then it's going to keep your risk under check. If you select a very risky underlying, then there are chances that you may end up with loss, or you may have to roll the wheel for a long time, and only then you will be able to break even. So let us talk about selecting the underlying stock. So let us say the number one rule for this strategy is, whenever you are selecting an underlying, you should be mildly bullish or properly bullish on the underlying. So it should not be that you are expecting the underlying to stay flat or expecting it to go down. You should be mildly bullish or more bullish on it. So let us take the example of some stock, let's say Apollo Tires. So I am slightly bullish on Apollo Tires and I want to construct the option wheel on this Apollo Tires. So now the first step is done. I have selected an underlying and I am saying that I am slightly bullish on it. So the next step would be to sell the cash secured put. So what exactly is a cash secured put? So basically it means is that whenever I am selling a put, I should be having the cash with me to be able to buy that stock in the equity market, normal cash market, if the stock falls to the strike price of that put. So let me explain that with an example. So I am selling a put of 200 of a February expiry, and I am going to sell this for say 1.25 rupees. So it's going to consume 80,000 as margin, and my profit on this put, if it goes to zero, would be 2500 into 1.25. So approximately 3125 is my credit on this put. So now there are two things which can happen. One thing is this put may go to zero, that the stock does not go to 200 at all. So while selling the cash secured put, let us say it was the month of February and the stock does not go. So the expiry of February month is on the last Thursday, which is 24th Feb. So let us say that this does not go to zero. In that case, the stock has fallen down to 200. But if the stock has not gone to 200, then this put will go to zero. So in the Feb month, I will end up making some 3000 rupee profit, as we saw here. Similarly, now when I sell this option again, so let us see the option chain of Apollo Tires. So here we can see all the premiums of different strike prices. now one thing which you have to be careful about is what strike price to select. So before I come to that strike price selection, let us move forward with this premium collection example. So in the month of Feb, if it does not go down to 200, the put will expire worthless and I'll be making this 3000 rupee profit. But why should I collect only 3000? Why should I not collect more? So this is where the problem which we have to address is what strike price should be selected. So as a rule of thumb, I usually go by collecting 1% of the stock's price as premium for an option. So if the stock is say trading at 223.8, so 223.8 is the current stock price, I would see that what is the 1% of this. So it's 2 rupees 23 paisa. So approximately 2 rupees I would like to collect. So what is the option which is giving me 2 rupee credit? So it's approximately 205 put. So since today is, we are already five days into the expiry of February, the premiums have reduced a bit. If I would have started at the very first day of the expiry, when the February series had started, then this 205 or maybe even 200 put would have given me 2 rupees. So let us take the example of 205 itself here. So I am going to collect 1.8 rupee. So my approximate profit would be somewhere near 4000. So 1.8 times the lot size of that put, it's 4500. So this is what I am going to collect, and I am going to keep the whole money if the stock does not end up below 205. So in the month of Feb, I have collected 4500 by selling a put which is giving me credit equal to 1% of the stock price. So let us write it down here. Collect 1% of stock price as premium. So whenever I am talking about the option here, so we are still selling the put only, we are not talking about calls yet. So after we have collected 1%, now what happens? Let us consider a scenario that the stock does not go to 205. So I get to keep the whole 4500. So my profit in the month of Feb would become 4500. Now again, so the margin I have used is approximately 80,000 as Zerodha was showing. In the month of March, I'll do the same. So wherever the stock is, let us say the stock is at 240. I will see which put is giving me 1% of 240, which is 2.4 rupees. And I'll sell the same put again. So even though puts of March would be illiquid, but let's see the premiums if they are there. So they are not liquid currently because there's a lot of days left in the February series. So these will become liquid only when the February series is in the last week of February series. So anyways, so in the month of March, when the March month is approaching, we will sell another put which would give me 1% of the stock price. So why am I doing this? Basically, I am trying to collect premiums by selling puts, and if the stock does not fall, I'll just keep selling puts month after month, and this is sort of like a passive income. And if the stock falls down, I should be ready to buy it at a price, because then I should be telling myself that it is a very good price to enter that stock. So since I am selling 205 puts, so if the stock falls down to somewhere near 205, it's a very good price to enter Apollo Tyres. I mean, that is my view, that I should be bullish on the stock and I should be ready to buy it at a slightly lower price than current market price. So what is the approximate payoff of doing this put selling? Let us look at that in terms of percentage. So I was collecting approximately 4000 on a margin of 80,000. So approximately 5% is my return on this each month. Now we can go far and we can try to collect lesser premiums, because that reduces the risk. So the farther you are, the lesser the risk, the lesser the premium. So if you don't want to collect 1% of the stock price as premium, you can collect 0.5% as well. And then because you will be collecting only 0.5%, you would be selling a much farther option. So maybe I won't be selling, say, 205, I might be selling 200 or 195. So if you want to reduce your risk and also reduce your ROI, you can keep going far and you can collect something which has less premiums. So maybe say sell 195, which is for 80 paisa. So this is how we keep doing it until we end up in a loss. So how can we end in a loss? So there is a chance that after say 4 to 5 months you kept selling puts, and then in a certain month the stock falls down. So the stock actually comes down to say 200 or below 200, and you had sold the 200 put. Then comes the third step, take delivery in loss. So what happens is you are selling your puts. Suppose again in March you collected 4,000 rupees, and then in April you again collected something, and then in the month of May the stock actually falls down. Now you have to take delivery of that stock. So what you will do is you will buy the stock in cash market. So now if we see how much money is needed to buy the stock in cash market, it's approximately 2,500, which is the lot size, so the quantity times the price. So if you are say selling 200 put and the stock has fallen down below 200, which is approximately say 190, let us take 198 as an example. So you would be buying the stock in cash market at 198. So you need to have approximately 5 lakh cash margin free. So now what happens is we have reached the third step of the option wheel. So you have taken the delivery of stock. Now you are not selling cash secured puts, you just bought the share. So you bought the stock. Quantity should be the same as the lot size of that F&O. So now that I have bought the stock, from that month itself we will start selling covered calls. Now what is a covered call? So as you may be knowing already that covered calls involve buying a futures or buying a stock and selling a call. So since we just bought the stock in this previous step, we have taken the share now, and we have taken it at a very good price, because remember that we were selling puts of much lower strikes. So whenever we are buying the stock, then that means we have collected it at a very good price, and we are also mildly bullish or maybe long-term bullish on the stock. So what would happen here is, after buying the stock in cash, you can start selling calls on it. So what does this mean? So this means that if the stock of Apollo Tyres has fallen to 200, so let us say that I have 2,500 quantity of Apollo Tyres and I have it at a price of 198. Now I can start selling calls which are a little upwards, which are a little away on the upside, and start collecting premiums. So let us look at the option chain on the upside. So 240 call is currently giving me 2.65 rupee. So coming to the credit collection, so it's up to us how far do we want to collect the premium on, but usually what we do is we try to sell a call which is 8 to 10% away or giving us 1% of the premium. So there are many variations of the option wheel. Some people sell calls also which are equal to 1% of the stock price. Some people sell 8 or 10% away from the stock price. So to give you an example, let us say that when I had the quantity, this much quantity of Apollo Tyres at a certain price, I can either sell calls which are 10% away. So when I say 10% away, it means that approximately 220 call, because 220 is approximately 10% away from the current market price, which is 198. So this is the current market price. So whichever month I have taken the delivery and bought the shares, that month itself I am starting to sell 220 calls which are 10% away from the current stock price. And whatever premium I get, I don't consider that. My basic rule is buy the stock in cash market and sell a call which is 10% away from the current market price, and whatever premium I get. Another variation is some people apply the same logic of collecting 1% of the stock price as a premium. So 1% of this would be 1.98, approximately 2 rupees. So then we can sell something like a 245 call here. So if I sell 245 call, I am collecting approximately 2 rupees, and then I am going to keep selling this 245 call and keep it as my passive income till the stock does not come to 245. So what would happen here is, for 3 of the months we did not do any call selling, we were just selling puts. Once we get assigned, we start selling the calls. So let us say that in the month of June, we collect premiums on the call. Then in the month of July, we do it again. And the stock is rising, but we are not changing our strike. So then we are basically selling calls. So June call goes to 0 because the stock does not come to this level. Then July call goes to 0 because the stock does not come to this level. Then finally in the month of August, the stock comes to 220, or maybe it goes higher than that, above 220. In that particular month, we close the wheel. So what we mean by closing the wheel, we will sell the stock in cash market basically, because we bought the 2500 quantity at 198 and now we are going to sell it for 220. So we have made approximately 10% profit. Plus we have sold some calls in the previous months which were our profit. Now this is where the wheel ends actually. So after selling covered calls, we turn the wheel again. So when do we turn the wheel again? When the loss so after selling covered calls, we turn the wheel again once that strike has been breached. So let us say that in the Feb and March month you collected premiums on the puts, and in the month of April you got assigned. So when I say assigned, basically the stock has fallen and we had to buy it in cash. So in the April we buy in cash, and from April itself we started selling the covered calls. So from the month of April we started selling covered calls. So sell a CE which is giving 1% of stock price as premium. Now from the month of April we started selling the covered call and we kept on selling. So taking an example here, from in the month of May, then in the month of June, we kept on selling the call. Which call did we sell? Which is 1% of the premium, 1% of the stock price as the premium. So now there will happen that if we are bullish on the stock and it actually keeps rising, there will happen a time where the strike price of the call is breached, and at that point of time we get rid of the cash position. So sell the cash position, and on top of that close the CE as well, because for that month also we must have sold the call. So this is a very basic passive strategy wherein we rotate a wheel, and once we have come down to closing the call, the whole position is closed, and now we can turn the wheel again, which means we can start selling the puts again. So if the stock has come up to 220, so we bought the share at 198 or 200 and then it went to 220. Again at 220, if we are still bullish, we can start selling puts of 200 again. So we are going back to step number 2, sorry. So we are going back again to step number 2. So now there are a few things to be kept in mind and be very careful about, because this strategy may sound like pretty easy, but it's not so easy. So before that, let us take an estimate of what is the return on investment in this strategy. So for the first few expiries where we were selling the cash secured put, we were actually collecting 3 to 4% as the premium. So as I could give you an example, we were able to collect 4,000 rupees on an 80,000 investment, which was like 5%. But obviously we have some cash aside to buy in case we get assigned. So the return on investment is not that high. So for every month that you are probably going to sell a cash secured put, you may get only 1% return approximately. So in this case, when I talk about the option chain, let us say that you were collecting 1.4, 1.5 rupee by selling 200 put, and you also had kept some cash aside to buy the stock in case you get assigned. So what exactly would be the ROI? So ROI would be your profit, which is say 4,000 approximately, divided by not just the margin which this Zerodha is going to charge you for selling a put. So it's only going to charge you 80,000, but the cash which you have kept aside, that should also be included in the ROI calculation. So approximately I would take it as 5 lakh. So it's coming out to be 0.8%. So this is how it is when we talk about selling a cash secured put. So we are approximately getting 0.8% a month. Now it can happen that you keep selling the put and you keep collecting 0.8% a month, and the stock never falls down to that price because you are bullish and it flies off. So in that case, what would be your annual return? So it could be very low, it could be as low as not even 10%. But as you could see that this strategy was even if it does not get assigned, this strategy is a basic strategy which is pretty much safe, and it gives you a certain low but safe return. Now if you would have got the delivery, then what would be the ROI? So let us say that in a certain month you collected 0.8%, then in the next month again you collected 0.8%, but in the third month you got assigned. So in that month you did not collect anything, and this could even turn into a loss. I would get back to it. And in that particular month you got assigned, you did not get anything, and you started selling the calls. So this was your put side, and now you will start selling the call. Now in the call case also, let us say that you are collecting only 1% of the stock price as a premium. So approximately you are getting the same return on selling the calls also. But the real return of this strategy comes from the point where you get the violation of the call strike. So since you are selling a call which is 10% away, so for a stock which is at 200, you are selling a call which is 220. So there would be a 10% move if your call is going in the money. Basically your call strike is getting breached. So there will be a 10% move somewhere in this line. So then that 10% move also comes, and then in that month you end the wheel, or maybe you choose to rotate it again by going back to selling the puts. So on an average, this strategy is known to yield approximately 20 to 25% returns. But this can only happen if you have executed it very cautiously and you have tried to maximize your ROI in whichever way possible. So one of the ways to improve your ROI is that when you are taking the delivery of the stock, you don't spend the complete money on buying the stock, instead you buy its futures. So that would reduce the margin required, but futures will always be slightly more higher priced than the stock. But in the larger scheme of things, when you talk about ROI, it would improve. So what do I mean by that is, if you were to buy 2500 quantity, obviously it's going to cost you 5.5 lakh. But if I buy Apollo Tyres futures, it's going to cost me only 1.35 lakh, and I am going to buy the futures and then start selling the calls in the month where I am getting it assigned. So if my investment is low and I still get the similar returns, then obviously my return on investment is high. So this is one of the techniques which a lot of people use. They don't take delivery in cash, they just buy futures and start selling calls whenever they are assigned, whenever the price falls to the put strike price. Now there is a major drawback in this strategy. Let us talk about the situation where you were supposed to take the delivery. So there could be a certain scenario that you were selling the 200 put, and in a particular month you had collected 5 rupees or say 2 rupees for this put. Now, which means you will start making loss if the stock falls below 198, and in that particular month the stock falls down to 195. So here actually you are not going to come out with zero loss while getting assigned, you will actually take some loss. So this loss will hit your ROI because it could be equal to the premiums which you had collected while selling the puts in previous months. So this is a drawback with this strategy, that if you are getting the assigned and you have sold a put which is a little away and the stock ends up much lower, then you are actually booking loss in that particular month where you are taking delivery. after taking the delivery, you start selling calls and you start reducing your cost. So this is one of the strategies which is a good strategy if it is executed properly, and it gives a certain return of 20-25% if you execute it properly. But there it has a lot of drawbacks. So one of them being this delivery situation, where we cannot take a delivery which is very low. If it is slightly lower than the strike price which we have sold, then it's not a problem. Now there is another way people look at it. So there are a lot of people who have a big portfolio of stocks. So how they use this strategy is, since they already hold the stock in their portfolio, they can just keep selling the calls, and whenever the calls strike price comes, they just sell off the stock in their portfolio. So let us say that you have a stock in a big holding, like Reliance is there, and you have Reliance 100 or 200 shares. So it's always advisable to sell covered calls. That is also like a wheel. Here we are not starting with cash secured puts because we already own the share. So if you already own the share, then you should always try to sell a call which is a little far away. So if I own say 200 or 250 shares of Reliance, because the lot size of Reliance calls and puts is going to be 250 shares. So if I already have 200 or 250 shares of Reliance in my portfolio, I should always look to sell calls, and I should try to sell calls which are far away, so that the price is not touched within a month and I am able to collect the premium. So here, so let us suppose that I have a big portfolio which has 200 shares of Reliance, and I just sell the call of 2500. So actually 250 into 13.5, approximately 4 to 5,000 would be my profit on selling this call. So if the stock does not come to 2500, I'll book this profit, and next month I will also sell the call again. So this leads to the reduction of cost basis. So what I mean by that is, every month that you are collecting the premiums and the stock is not reaching that strike, your net cost of owning the shares is falling down. And there are chances that when we run this wheel, the net cost of owning the shares falls down drastically. It may even reach zero. So if that has happened, then also you stop running the wheel. That is one of the ways people stop running the wheel and they move to another stock. So now I'll summarize this. So the option wheel strategy is a very complex strategy, but you need to have patience to execute this. So one of the things you have to be careful of is select the right underlying. So it should not happen that the underlying is very, very volatile, or you are just running the wheel for the sake of it. You are not bullish on the stock. So now second thing which you can do is, so now the second step is selling a cash secured put, which I explained that you should sell a put and wait for the stock to come down to the put price, and when it comes down, you buy the stock. Either you buy the stock in cash or you try to buy the stock in futures. Once you have taken delivery on the loss of the put, so once you own the shares or once you have the futures, you start selling covered calls. So you will start selling calls which will give you approximately 1% of the stock price as premium. So if it's a 1100 rupee stock, you try to collect 11 rupees. So something like that. And then once the strike of call is touched, so the stock has risen and it has breached the strike of the call, then you close out the wheel or you start turning it again. So you close the position, you sell your futures or you sell your cash equity, and you also close the call which you had sold, and then you turn the wheel again. Now, in my personal experience, I can suggest that once you have run the wheel on a certain stock, don't repeat it again on the same stock. Try to find some other underlying which is at a lower level and which has not run up 15-20% in the last 1 or 2 months, because if you are closing the wheel, then that means your stock has actually moved 10 to 15% in the last 1 month. So try to avoid repeating the wheel on the same stock, but it's always advisable to run the wheel on highly liquid stocks, or maybe you can use it on index also. Using on index, I don't have a very good experience. I would suggest try to do it on stocks like Reliance or TCS. So the stock should be liquid, the stock you should be bullish on, and try to avoid running it on the same stock again and again. Instead, you should have a basket of stocks which are good for running this option wheel, and you can keep running them one after the other. So that is all for this. Do let me know if you did not understand anything about the option wheel, or you have any other variations of option wheel, because option wheel has a lot of variations and a lot of ways to manage. Maybe you can write about it in comments, and you can ask me if there is any particular thing you want me to address. So thanks guys, thanks for watching, and do let me know.